There's been a downturn with hiring in the United States, and the country continues to deal with affordability and inflation challenges as tariffs and the crisis in the Persian Gulf raise costs for businesses and consumers. Europe is struggling with weak growth and rising energy costs, while developing countries are battling higher trade barriers and energy costs. Later, we'll discuss conditions in China and the rest of the global south, but we begin in the United States. John Tamny is president of the Parkview Institute and editor of Real Clear Markets. His new book is The Deficit Delusion. And also with us is Anthony Chan. He served as chief economist with JPMorgan Chase. Thanks to both of you for being with us. Anthony, let me start with you. Let's start with the July jobs report. It was surprisingly weak, with payrolls falling by 23,000, and the 2 months prior to that were also revised downward. What does that tell you about the health of the U.S. labor market?
Well, it's telling us that there is some weakness in the labor market. Anytime you have a decline in jobs, you can't really say that's a good thing. The silver lining, however, is that because of all the changes that have taken place in the labor force, deportations, and of course demographics and things like that, you just need somewhere between 25 and 50,000 just to break even. And in fact, you saw the unemployment rate coming down, but not for good reasons. Because the reality is you saw less people working, more than 80,000 people lost their jobs, and then you saw a couple 100,000 people basically dropping out of the labor force. And Anand, I can assure you that none of those people dropping out of the labor force had jobs. They not only did not have jobs, but they don't get counted as unemployed. So the reality is that the underlying theme with that employment report suggested weakness. And you also saw that, Anand, in the wage numbers. The wage numbers came in softer than expected, and now wages are only rising 3.2% year over year. So they're basically not making much progress given the underlying inflation rates that we're looking at right now.
Right. Anthony, President Trump continues to insist that Americans are thriving under the economy, but not everybody agrees with that. Of course, there's the mayors of major cities across the country, across the political spectrum as well. They say that the golden age described by the president is far from the everyday reality that residents face. And, you know, the word that we hear most often to describe the sort of consumer crisis that many people face is affordability. Is that getting to some kind of crisis point right now?
I think we're still in a difficult situation with regard to affordability. When you look at the fact that energy prices on a year-over-year basis are basically, according to the Consumer Price Index, going up by more than 40% year over year. And if you look at average hourly earnings, they're rising 3.2%. So I don't think this is the new math or even an exaggeration on my part. If your wages are going up just barely above 3%, but energy prices are going up more than 40%, there is an affordability problem. And it's not just energy prices. There's a lot of other prices that are rising faster than wages. So yes, we do have an affordability problem. And I know that people have been talking about the C-shaped economy instead of a K-shape. The C-shape suggests that people are catching up. And there's a lot of statistics out there to support that view. But all I have to say is if wages are only rising by the numbers I've given you, and right now, that's not enough for these low income or the bottom 40% of the population or income earners to basically catch up. Simply not enough.
John, if we look at the U.S. economy, it is growing, but not as quickly as before. I mean, people are spending, but as we've just heard, hiring has slowed sharply, and prices continue to rise faster than the Federal Reserve would like. I mean, the economy is not in a recession, but recent data suggests the risk of a slowdown is increasing. What's causing that? I mean, to what extent are tariffs playing a role in that?
Well, I think it's got to be said the economy is always growing so long as people are working together. The only limit to human potential is the ability to divide up as much work as possible with as many hands and machines as possible. And so when you factor in tariffs, tariffs are a tax on the division of labor. And so they would certainly be having some sort of dampening effect on the economy. You also have to factor in that any war, no matter how small, no matter how large, is a world war in the sense that the economy precisely because it's global. Everyone's working together in the production of all market goods. And so you put those two factors into place, there is going to be a slowing economy. Is it going to be a recession? I think the way we define recessions in America is pretty bankrupt, but I think also it's got to be remembered that a slowdown in the US is boom time anywhere else. And so in a perfect world, we wouldn't have these tariffs. In a perfect world, we wouldn't be at war. Uh, but in the bigger picture of the American sense, it's not going to mean too much.
Right, and John, we are already seeing the impact of higher energy costs. The US inflation rate is running close to 4%, which is actually double what the Federal Reserve's long-term goal is of 2%. At their most recent meeting, the board of the Federal Reserve voted 9-3 to keep its benchmark interest rate steady at 3.5 to 3.75%. There were three regional bank presidents that dissented. They favored a quarter-point increase. I mean, with inflation still a concern, and as we've just heard, the labor market showing signs of cooling, I mean, what should the Federal Reserve be most worried about now?
Oh, well, the Fed really can't do anything. Let's never forget that prices are an effect of remarkably sophisticated global cooperation among hands and machines, billions of people, billions of machines. This notion that the Fed can fix prices is just, it's not fit for serious discussion. So the Fed can continue to fiddle with rates and it'll get economists all excited. But back in the real world, what drives prices down is one thing, the globalized division of labor. So I don't think the Fed can do too much, but what can be done and what's not been done realistically for decades in the United States is to recognize that a strong dollar matters. Is it some sort of lucky break? Was OPEC feeling really generous in the 80s and 90s when oil fell as low as $7 a barrel in the 80s or $10 in the 1990s? Certainly not. The difference was in those decades, the price of a barrel of oil that is priced in dollars, the dollar was strong. Since George W. Bush got into office in 2001, we've had a succession of presidents who've not just overseen weakening dollar, but have cheered it. And so it's no surprise that oil's high today. You want to fix that, get serious about dollar policy again. That's something that the U.S. Treasury can uniquely do.
Anthony, let's talk about the tariffs that President Trump has just expanded. There are now additional tariffs of 10% to 12.5% on goods, and these affect about 60 countries, imports from 60 countries. These duties replace earlier emergency levies that were struck down by the United States Supreme Court. The Trump administration said it has refunded $100 billion of those tariffs that were collected earlier. Those were collected when President Trump announced his Liberation Day tariffs. One other question is, how are these tariffs legal?
Well, I just wrote a Substack article on this topic, and my prediction is that these tariffs will also be declared illegal. And the reason is the authorization that they use for these tariffs are basically that somehow something went, the forced labor situation. But the authorization here is basically to impact several countries, but to basically say that 60 countries are all guilty of the same charge, it certainly goes against the grain of that authorization. So I think that it will, in fact, eventually, and already some legal lawsuits have already been filed, will make it somewhat illegal. Now, keep in mind that we've been talking about the economy related to these tariffs, and what people don't talk a lot about, and I've been talking about it to some extent in client presentations, is that the second quarter, even though it wasn't super strong, it came in stronger because of the FIFA. It also came in stronger because of the one big beautiful bill, all these tax refunds, and the fact that people did not adjust those. They didn't adjust the tables, so people overpaid in taxes. So not only did you get a big refund, but you also overpaid on your taxes because you didn't adjust the new tables. And then the fact that you just mentioned, the most important one, they gave back $100 billion worth of tariffs. That was a huge stimulus in the second quarter. Now they're starting to collect tariffs. Tariffs are a tax, as you just heard a little while ago, and that reduces consumer spending because when you impose tariffs, everything costs more, so you can buy less of other goods. that slows down demand. So that is going to be something that's going to hold back economic growth in the second half of the year. And we don't have any more extra tax refunds, and we don't have all the things like a FIFA, the World Cup scenario. So all those things are going to hurt in the second half. They supported the economy in the second quarter.
John, notwithstanding the fact that these latest tariffs will face legal challenges, I mean, we also have trade uncertainty as well. How do these affect things like business hiring, investment, and consumer prices as well?
Well, again, I don't think they affect consumer prices nearly as much as people think, because again, when I look at consumer prices, I look at how much the global economy is in sync. And so is it any surprise after 2020, when much of the global economy was put into freeze mode by panicky politicians, the prices rose after the fact? You can't rebuild supply chains. You can't rebuild sophisticated production techniques in a matter of months or even years that took years and decades to build. And so I think the focus, again, consumer prices, naturally they're going to be elevated because of what happened in the past, but because we continue trying to break up what is a globalized mode of exchange. Tariffs break the natural human desire to divide up work. Wars do the same thing. What is it? 1/3 of all fertilizer travels through the Strait of Hormuz. And so with fertilizer more expensive right now as a consequence, it's only logical that that's going to buffet food prices around the world. The problems we have to consumer prices can't be fixed by governments other than governments simply getting out of the way and instead of pointing guns at each other, figuring out ways to solve their problems without war.
Right, Anthony, you were talking a moment ago about the GDP figures for the first and second quarters. Well, if we look at the second quarter, GDP grew by 1.5% compared with 2.1 in the first quarter. I mean, are we looking at a temporary slowdown here, or is this a broader loss of economic momentum?
Well, believe it or not, these tariffs are impacting the GDP numbers, Anand, because what you saw in the first half of the year is that a lot of companies were trying to front run the tariffs. So they imported a lot. So that's one of the reasons why in the second quarter, you basically got a much lower headline GDP. And of course, you were lucky because the data centers added to GDP significantly, close to 1%. So that kind of offset that. And now in the third quarter, you're going to get a stronger number, but it's also going to be a mirage because now all of a sudden, since the imports were front run in the second quarter and in the first quarter, you're not going to have as many imports in the third quarter. And of course, imports subtract from GDP. So that's going to add to GDP. And that's one of the reasons why the Atlanta Fed nowcast model has given you such a strong number for the third quarter, but it is an illusion. It's simply because of these distortions because of the tariffs. And the tariffs, unfortunately, are distorting the economic statistics, and they're also distorting the way consumers behave because a lot of consumers don't want to pay the tariffs. So they start either doing without the products or substituting for the products. So it does cause major disruptions, and it certainly causes major disruptions for businesses because when you have tariffs that are going up, going back down, they're legal, they're not legal, that creates a lot of uncertainty, and businesses hate uncertainty, and uncertainty is not a good thing when it comes to business investment.
Okay, and we have to leave it there. Thanks to both of you for being with us. The Global South is going through a mixed economic period. Growth in many developing economies remains faster than advanced economies, but the picture is uneven. China's economy remained resilient in the first half of the year, but weak consumer spending and uncertainty in the global economy continue to pose challenges. Joining us is Gilson Schwartz. He is an economics professor at the University of Sao Paulo, and Liang is a chair professor in economics at Willamette University. Thanks to both of you for being with us. Liang, let me start with you. As we just heard from our previous guest, this is a time of much uncertainty in the global economy. But if we look at the numbers for China, China's economy expanded by 4.7% in the first half of this year. And it's on track for a full year growth goal of 4.5 to 5%. What are the main drivers behind the kind of growth that we are seeing in China?
Yeah, good to be with you, Anand. So I think China's economy remains resilient, as you mentioned. So there's some weak demand domestically, especially when it comes to fixed asset investment. That's gone down by 5.7% in the first half of the year. I think actually consumption growth was steady. It's around 2.7% growth, especially when it comes to retail sales of services. That is actually over 5% of growth. But what is weaker, I think, is on the fixed asset investment side. On the other hand, I think China's export performance has been really resilient and robust. Again, when you look at the first half of this year, China's exports has grew by around 24%, and import grew even faster at around 27.5%. So that really robust export growth helped to lift China's growth rate. And I think that also really reflects China's structural transformation, because when you look at China's exports, it's not only exporting to developed countries, it's mostly developing countries that China is seeing higher growth rate when it comes to exports for ASEAN countries to BRI participant countries. So China really grow the sort of trade ties with the global South countries. And also when it comes to the trade structure, China now exports a lot of high-tech products, 3D printers, robots, and also a lot of green products like EVs and lithium batteries. So all of these really support China's export momentum, and that help to offset some of these weak domestic demand. But that said, I think the overall consensus, and I think from the Politburo meeting in July, is that China will take measures and trying to strengthen its domestic demand, especially when it comes to this relatively weak investments.
So, Liang, we have robust exports. Imports are not doing badly as well. But if we look beyond that, I mean, how significant are China's investments in things like high-tech manufacturing, EVs, renewable energy? I mean, that's a big export market there as well, and other emerging industries. I mean, is this the new economic model for growth?
Yes, so we're seeing China's structural, transformation. I think the weak demand has to do with the old sector, like the real estate sector, and some of the low value-added manufacturing. They are, giving way to these new economies. So the new trio and the new trio. Now we're talking about robots and innovative drugs and medical equipment, advanced manufacturing. These new economies are really taking over the old sectors. And that's why in this kind of transition periods, you're seeing relatively weak demand, especially when it comes to investments in manufacturing and infrastructure, and relatively weak, consumption demand because of these wealth effect due to the slowdown of the property market. But that said, when you again look at the high-tech manufacturing, it is growing at over 13% in the first half of the year. So I think the new economy is really taking shape and help to recover some of these domestic momentum. And I also wanted to address that even though export has been helpful, but when you look at really the first half of the year, when you look at the contributions to GDP, domestic demand still take up over 82% of the contribution to growth. So in other words, capital formation and final consumption contributed 82% of the real GDP growth in the first half of the year. And net exports contributed to about 18%. So primarily, China's growth is still domestic demand driven. But of course, China still try to find ways to strengthen domestic demand, especially given the very uncertain external environment.
Gilson Schwartz, Brazil's economy grew by 1.1% in the first quarter of this year, and that was an improvement if we look at the slowdown in late 2025. Annual GDP growth sits at 1.8%, while annual inflation is around 4.5 to 4.6%. And the unemployment rate in Brazil recently hit a historic low, roughly 5.4%. I mean, what's behind those numbers, and how sustainable is it?
Well, I think Brazil is now in a very curious situation because, on the one hand, there are lots of fears in the horizon related to fiscal issues. But on the other hand, it's really a case, an international case in terms of successful stabilization policies. Inflation is really moderate. Interest rates are still high, but the central bank has already sent signals that it's supporting a recovery. It's supporting a more moderate approach to inflation stability. And the fact is that we are about 1 month, a little bit more, 1.5 months from elections. So nothing will change. And this is the result of a long-term adjustment, the success of stabilization policies. The central bank has been very, very hard in terms of controlling inflation and getting really serious about keeping interest rates as high as possible for the sake of this stability. So internal consumption, despite high interest rates, despite the fiscal uncertainty, domestic situation remains the main anchor for a long-term growth. Not spectacular growth, but growth with price stability, which I think is the major conquest, the major victory of the Lula years.
Gilson, in June, Brazil had a positive trade balance of $10 billion, and it was fueled mainly by a very strong export market, robust exports in crude oil for one, iron ore, soybeans being another, mainly to China. So if we look at this, I mean, to what extent is Brazil's economy affected by the slowdown in global trade, as well as what we are seeing right now, which is rising protectionism?
Well, there is a slowdown, of course, but there is also a trade diversion, new routes, new customers, stressing the diversity of the external trade, of the Brazilian external trade. And then Petrobras is really a huge success. I mean, the crisis for Brazil has brought tremendous profits for Petrobras, the state oil company. So it proves the point that Brazil, first, has a diversified export pattern, a diversified export structure. We have strong state companies like Petrobras that signal a capacity to invest that is unprecedented. And last but not least, Lula has been successful in projecting that kind of leadership that, despite the fiscal issues, no economist these days really risks going against the opinion that the next government will stabilize fiscal issues and there will be a continuous decline in interest rates.
Liang, if we look a little more closely at consumer spending in China, I mean, it is weak right now. I mean, what's holding consumers back and what needs to be done to change that?
Right. So again, we're seeing the bifurcation, I would say, in consumption. Consumption of retail goods, as you mentioned, is relatively slow. It grew only at 1.1%. But when you look at the consumption of services, that has gone up by over 5%, 5.3% in the first half of this year. So I think, for one, is to really pay attention to this kinds of changes structurally, that now, at the income level, per capita GDP at around $13,000 per year, I think people are now really switching from consumption of goods to more services, right? Experiences. So I think a lot of efforts should be made to expand the kind of service provisioning, because there's still many places where the services are not well, I think, provided when it comes to, for example, elderly care and also child care, and so on and so forth. So by providing better services on these areas, I think it not only helps to directly stimulate consumption, but it also eases people's mind, right? If you have good elderly care, if you have good education system, it reduces the so-called precautionary savings. So I think that would be helpful. Now, going back to the reason why consumption is relatively slow, I think that really has to do with the real estate slowdown, the real estate sector adjustments, because most of the Chinese households' wealth is concentrated in the real estate sector. So when the house price is going down, people will feel they're poorer. And so that restricts some of the consumer confidence and spending. Also, we know that household spending, a lot of these spending is on the housing related expenditures. So buying a house, that really induce a lot of the savings sitting in the banks, because people are not buying the houses for now. So that is why I think the savings rate are so high, where consumption spending is relatively low. Also, when it comes to people are not buying houses, and you're not buying a lot of the household appliances, cars, and so on and so forth. Yeah. So I think that's a lot to do with both the structural changes, switching from goods to services, as well as the real estate sector slowdown. With that, I think many changes in the economy. The old sectors are weighing off, the new sectors developing, right, which is also tech intensive. So I think it makes people worried about their jobs, their income prospect. So I think there's a lot of these kinds of wealth effect and confidence issue.
Gilson Schwartz, President Trump announced a new round of tariffs, and those went into effect on July 24th. I mean, that's an additional 10% to 12.5%. As we heard in our previous panel, these new tariffs will probably be challenged in court yet again, and they are likely to be declared illegal as well. But, you know, before all that happens, I mean, how do these tariffs affect a country like Brazil? And it affects a number of other Latin American countries as well, including Colombia, Peru, as well as Chile.
Well, the situation from that perspective is highly politicized. There is a tariff war, that's for sure, but there's, on the other hand, a very, very active attitude from the US government to, in a sense, block those who are center to left oriented. There has been a movement in Latin America towards a more conservative approach, and the tariffs, in special for Brazil, have been mostly politically biased. There's not really a strong effect in terms of our trade performance, external trade performance. There has been a lot of debate here about taxing exports so that there would be more supply, domestic supply of goods that are being exported, thus helping to fight inflation. But anyway, the main issue here is elections, presidential elections. Everyone is focused on that. There will be no policy changes in the short term. This is something that might happen next year. So for the moment, Lula and his team are betting on stability and negotiating, not facing a fight, an open fight with Trump or with the tariff war. There's been all this discussion about retaliation, but it just doesn't take off in Brazil. It's mostly a stable scenario, and tariffs are not imposing such a burden as expected initially, especially because there is trade diversion, and companies like Petrobras show that Brazil has a diversified state structure to face all those uncertainties. It's really amazing, and it's a case to be studied. I think Brazil is now an exception in terms of emerging countries. Now, with respect to Latin America, it's not as hopeful, it's not as optimistic. You see Argentina, inflation has been under control, but still deindustrialization and issues related to the social impacts of this policy to keep inflation low are very much on the agenda. So Brazil, compared to Latin America, is in a better position. Latin American countries are still facing issues that are related to an adjustment that they never done in the past. Brazil, for that kind of issue, at least did some adjustments and accumulated a huge amount of international reserves. So once you have exchange rate stability, high interest rates, and a viable, a feasible fiscal expansion policy, politics comes first.
Okay, and that is it. We have run out of time. Thanks to both of you for being with us. And that's it for this edition of The Heat. I'm Anand Naidoo in Washington.